I got countless of requests of people asking me to do an update on Crocs stock. This is a video actually I did a year ago. I talked about Crocs when it was around $55 per share. I said the stock is extremely undervalued. I saw over 150% on the upside. And after that, the stock actually did go up 150%. It went from $55 per share to $147 per share. And now the market is freaking out about Crocs. The market's not liking it anymore, and the stock is sitting at $94 per share. And I think this would be an amazing time to do an update on the company and pretty much everything around it. Now, a lot of you are not going to touch this company because maybe you hate Crocs, maybe you believe Crocs are out of style, no one wants Crocs shoes anymore, or those sandals or whatever. And I do really understand that. But the numbers actually have been proven the opposite, not just this year, not just last year, for years. And if you just look at Google Trends, the interest over time for Crocs is pretty much an all-time high. And I'm going to show you how much they're actually growing in Asia, over 39% in Asia. Pretty amazing growth numbers, which would show you that Crocs is not out of style. But even if Crocs is not out of style, the company actually has an amazing business, it has amazing margins. If you look at the net income margins between Crocs and Skechers or something like Nike, which is not the best comparison, but this is the best thing I was able to come up with. And you look at their latest margins, Nike's net income margin is around 10%. Skechers' net income margin is 6.5%. Crocs' net income margin is closer to 19%. 19% for these ugly sandals that people don't want. They actually want them because sales are going up. And they are very profitable, which is very funny to me. It doesn't cost them a lot to actually make these kind of sandals. And the interest is there. People actually want them, which is pretty amazing. And if you combine that with a PE ratio of 7 times earnings for something like Crocs, to me, this is an amazing company to look into. And this is why I'm going to get into the details a little bit more. Now, if you look at their latest earnings report, it wasn't actually bad at all. The company grew 13.8% in 2023. Asia Pacific revenues grew 39%. People in Asia and China really like the Crocs brand. It's not going out of style over there. It's still fine. But then Crocs, I believe, was it last year or the year before? I think it was in 2022. They acquired a new company called Hey Dude. And most of you are familiar with Hey Dude here in the United States. It's one of the top kind of bestseller kind of sneakers brand for a lot of young people. They have a lot of reviews on Amazon. A lot of people like the Hey Dude brand. Something that actually disappointed the market was the growth. And the growth only increased 3% for revenues, which is disappointing and is below the expectations, and is freaking out a lot of investors that might believe that maybe Hey Dude is not some kind of a durable brand like Crocs and Nike and Adidas that people want all the time. Maybe Hey Dude was just a one-off, where it just got popular, people wanted it for a year or two, and then now it's not growing as much as it should, and maybe people, they don't want Hey Dude anymore. Maybe they just want something else. So this brand is not durable, it has no moat, and Crocs took over $2 billion worth of that to acquire this brand that's only growing 3%. Although they did a lot of improvements on the free cash flow side within Hey Dude, and a lot of the free cash flow and the profit margins are improving within the brand since it got into the Crocs ecosystem and supply chain and all their connections. It has been pretty amazing, but the growth has been disappointing for Hey Dude. And this is, in my opinion, one of the reasons why the market really freaked out around the company. But if you look at the Asia Pacific, I mean, this is just stunning for just this kind of ugly, sandals or whatever you want to call them. Over 30% CAGR from 2020. Amazing stuff for the company. It has been managing the inventories very well, from 502 to 472 to 436. This is a massive improvement in inventories. It's not like the other retailers and kind of makers of brands and stuff. It's not facing a lot of inventory problems. This is all pretty amazing with the company. And the company even raised guidance, their previous total revenue growth, but within 11% to 14%. Now it's 12.5% to 14.5%. If you look at the EPS, it was as low as $11.17. Now the lowest is $11.83 to $12.22. So they upped their guidance on pretty much everything except the Hey Dude brand. And this is what's freaking out the market. If you look at the reported revenue growth, it was in the mid-20s. Now it's between 14% to 18%. So a lot of the market is actually believing again that Crocs has overpaid for Hey Dude, which is why Crocs was going down. And I said it was a massive overreaction because the market was believing that this making a new acquisition is taking on a lot of debt, and maybe Crocs is just overpaying for Hey Dude. But this was not the case. Crocs was putting good numbers with Hey Dude. Now the numbers are slowing down, and the market is freaking out again, which is, it's not good at all. But in my opinion, if you look at the company in total, they still up their guidance. So the Crocs brand is growing amazingly well. And Hey Dude is not doing too bad. And if we look at the balance sheets, they have $166 million of cash. You look at the long-term debt, it's around $2 billion. It might freak out a lot of you, but if you look at the free cash flow, it has been averaging around $500 million over the last 3 years to around $600 million. So $500 million, they have $2 billion of debt. They can pay back the entire debt in 4 years, which is not a big problem with me because Crocs is a free cash flow machine for this company. The stock-based compensation is nothing crazy within their free cash flow kind of stuff, which is why I'm using it in this video. So I don't believe that is a concern. Maybe Hey Dude is some kind of a concern, but the company can afford it. Massive free cash flow. I think a lot of bad is priced in within the company at 7 times earnings. But I'm going to take a look at my valuation model to determine if Crocs is actually undervalued at such prices or not. Now I use 13% for 2023, which is pretty close to their guidance, around 13% to 14.5%. Then the analysts, they have 9 to 10% from 2024 to 2027. Now I went my own way and I used 8%, which is much lower than their own estimate. And I think from 13% to 8% is a very fair estimate to make. We're just guessing. It's all guessing. We don't know anything for sure. But I believe this is a very, very likely kind of scenario. Net income margin, we talked about it. It's around 18%. I kept it at 18%. Now the company is trading around 7 times earnings. I think this is very undervalued. Crocs is paying down debt, is buying back a lot of stock, creating value for shareholders, pretty amazing stuff. I think 10 times earnings is a much more kind of fair number for a company like Crocs. If you look at the historical average for the company, it was trading at 19 times earnings, and now it's trading around 7.3. I think 10 times earnings is not unreasonable after they pay down the debt, after the company the market stops freaking out about, hey dude, maybe it's more mature within Crocs 4 to 5 years from now. There's more visibility into the growth numbers, into everything. So I believe 10 times earnings is fair, and a 3% buyback yield I put in as a dividend because the company buys back 3 to 4% every single year. This would get me 85% on the upside, or 13% every single year for the next 5 years. This is not bad at all. But if I want to double my money with a company like Crocs safely, because maybe the growth is much, much higher, maybe it's 10 to 12%, then the upside is much, much higher. Maybe the PE ratio is 12 or 15 times, which is still not unreasonable for a company that has 18 times or 18% net income margins. But I think as a kind of a fair value kind of scenario, I would love to buy Crocs around $86 to $87 per share, which is actually not very far from here. Now, I'm not sure if Crocs is going there. I mean, looking at the chart, it looks like it's going to something like 80 or 85 or $82. But I'm just seeing a lot of bad sentiment with the company at 7 times earnings. It's extremely undervalued. I mean, if it gets to low 80s, in my opinion, Crocs is a very, very interesting company, extremely interesting kind of stock. I think it's also good to maybe sell put options on it. The volatility is great. The premium is not bad if you want to own it as a long-term investor. This was just my opinion, and I could be wrong. So this is not financial advice, of course. Thank you for watching this video, and I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.